Let's just say that when 55% of all ETFs and mutual funds are passive, it means the structure of the stock market has changed significantly. Dumb money is pouring into the markets mindlessly, without regard for valuation or fundamentals. As a result, wonderful businesses are no longer rewarded through direct investment in their shares. Instead, most of the inflows are funneled toward the mega-cap firms at the top of the index. This is precisely why we're seeing the spread between the S&P 500 and its 200-day moving average reach historic extremes. The S&P 500 is currently trading about 13% above its 200-day moving average. In the past, whenever the S&P 500 has traded this far above its 200-day average, it has typically signaled that valuations are rising faster than earnings. The red and blue lines are the 50-day and 200-day moving averages. They're key indicators that show the market's overall direction. The 50-day average reflects the short-term trend, while the 200-day average shows the long-term trend. When the price is above the 200-day average, the market is seen as bullish. When it falls below, it's a bearish signal. If the 50-day line crosses above the 200-day, that's called a golden cross, a bullish sign. If it crosses below, it's a death cross, a bearish sign. Right now, in November 2025, the price is well above both lines. The 50-day is also well above the 200-day, showing the golden cross happened a while ago, and the uptrend has stayed strong. Two main factors are influencing the environment the markets are in right now, and it is inflation and unemployment. Unemployment is now sitting at roughly 4.3%, slightly growing, while inflation is around 3.0%, which is not exactly favorable. 2% would be much better. What's more important is the trend from which we'll be moving on from now. More loose conditions will support economic growth with unemployment dropping. However, that is usually accompanied by inflation growing too, as consumers are spending more. If conditions are tightened, then inflation cools down. However, unemployment rises. The main factor determining how loose or tight financial conditions are is the federal funds rate. Following the recent Fed rate cut, there's been renewed discussion around the so-called R-star, or the neutral interest rate. The Federal Reserve has cut interest rates by another quarter point, lowering its benchmark lending rate to a range between 3.75% and 4%, the lowest level in 3 years. In macroeconomic terms, such a move is typically seen as supportive of growth, as lower rates make borrowing easier and encourage more investment. Recently, the topic of R-star, also known as the neutral effective funds rate, has gained attention. The R-star represents the theoretical interest rate that both maximizes employment and stabilizes prices, aligning with the Federal Reserve's dual mandate: maximum employment and price stability, or in other words, low inflation. The key question now is whether lowering the rate to 3.75% will actually deliver the desired outcome. It's possible that the move won't help that much to boost employment, but could instead fuel higher inflation. That would be an exact opposite of what we'd want to see. And it's important to remember that inflation doesn't only affect goods and services, but it can also inflate asset prices. We've seen this form of asset inflation, particularly in equities, play out many times before. We think that the September inflation rate of 3% could this way rise further, following this rate cut, potentially reaching around 3.5% year over year by December. You've already seen this chart earlier. It shows that about 55% of ETFs and mutual funds are now passive. In other words, index funds and ETFs together make up over half of all US equity ownership. Back in 2012, that number was just 25%. Now, it's more than doubled. That's a massive structural shift in how the market actually works. Passive investing naturally favors the biggest companies, the ones already at the top of the index. It's not like when new, promising businesses used to attract investor capital directly. When you invest through an index fund, you're basically keeping the old names in charge. The big players get bigger, and new innovators struggle to get noticed. This creates a self-reinforcing loop. Money flows in, prices go up. Those stocks take up a bigger share of the index, and even more money flows their way. This is also one of the factors we now have the forward price earnings ratio for the S&P 500 at level of 23.5, the largest since .com in 2001. Valuation ratios have essentially lost meaning when everything is concentrated into top firms that represent major part of the index. This doesn't mean the firms are not doing well. The Q3 especially has been very strong for many S&P 500 companies. Forward earnings per share rose to another record high of $299 $2.61. It is nearly at the $300 level. The tempo of growth is rapid. But today, we're seeing real herd behavior. Everyone's moving in the same direction, buying the same products at the same time. And the problem with herd behavior is, once the herd turns around, everyone runs the other way too. So if retail investors who've been pouring money into ETFs suddenly decide to sell, we could see a wave of selling that hits the whole market at once. We are not saying the market is going to crash. What we're saying at Gleneus is there's something a little bit off in the way the structure has evolved. This is why we're aware of those risks, especially the high correlation among equities, as that does not create diversification. This current rally can work when prices rise, and problems will erode once prices stop rising. We think not necessarily a crash like in 2008, but a quick and rational correction or two. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Gleneus.